Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden meanings behind corporate filings. And today we are going to peek behind the financial curtain of a giant in the ski and resort industry, Vail Resorts. Incorporated, get ready for some eye-opening insights. Right off the bat, Vail Resorts Incorporated is showing some interesting financial movements for the year ending the 31st of July 2025. Their total assets stand at a massive $5.78 billion. This is up from $5.69 billion in 2024, showing growth in what they own. On the flip side, their total liabilities also increased, hitting $5.02 billion in 2025. This is a significant jump from $4.66 billion in 2024. What does this mean? It appears they are taking on more debt or other obligations to fuel their growth or capital expenditures. Now let's talk about the bottom line, the profit picture. For the year ending the 31st of July 2025, Vail Resorts Incorporated reported a net income of $280 million. This is a healthy increase from $231 million in 2024, and even higher than the $265 million reported in 2023. So financially speaking, they appear to be doing quite well on the profit front year over year. Let's dive into how their individual business segments are performing. Their mountain segment, which is the core of their ski resort operations, brought in a mountain reported EBITDA of $821 million in 2025. This is up from $802 million in 2024. This indicates their ski resorts themselves are generating more operating profit, which is a great sign for their primary business. Their lodging segment, however, saw a slight dip. Lodging reported EBITDA was $22.8 million in 2025, down from $23 million in 2024. This might seem small, but it shows that while the mountains are booming, the hotels and lodging operations are facing some headwinds or perhaps not growing as fast. Digging deeper into the mountain segment, lift revenue, which is a huge part of their business, saw a 4.2% increase to $1.5 billion in 2025. This is driven by more expensive pass products and increased skier visits, which is a win. However, it is interesting to note that retail and rental revenue decreased by 4.6%. This suggests that while people are coming to ski, they might be spending less on gear or souvenirs, which could be a point to watch. Overall, Resort reported EBITDA, which combines the mountain and lodging segments, reached $844 million in 2025, up from $825 million in 2024. This is a positive trend showing their core resort operations are growing in profitability. Now, no business is without its risks, and Vail Resorts Incorporated is no exception. A major concern they highlight is the risk of prolonged economic weakness. They plainly state that skiing, travel, and tourism are discretionary activities, meaning people cut back on them when times get tough. With their high ticket prices, this makes them particularly vulnerable to recessions or even just economic uncertainty, which could mean fewer visitors and less spending. They also point out that international visitation can be heavily impacted by exchange rates and travel restrictions. And of course, there is the weather. This is huge for ski resorts. Unseasonably warm weather means less natural snow and more costly snowmaking. Too much snow can increase costs and make access difficult. Climate change is also a big worry here, with potential for decreased snowfall and more extreme weather events, which could really hurt their business. They specifically mentioned that the 2023-2024 ski season saw lower snowfall and variable temperatures, which definitely impacted their business. Their popular Epic coverage program is also a double-edged sword. While it aims to build customer loyalty and provide peace of mind, it also means they might have to issue significant refunds if resort closures or personal qualifying events occur. The report notes that the estimated amount of refunds reduces their past product revenue, and that actual results could vary materially from these estimates. This is a financial commitment that could impact their earnings quite a bit if many customers claim refunds. Competition remains fierce. They operate in a crowded market with numerous competing ski areas and other recreational activities. They point out that there are about 780 ski areas in North America alone. Their competitive advantage seems to lie in their iconic resorts, strong brand, and their data-driven approach to selling season passes. They are also actively expanding their portfolio, which includes international acquisitions like Crans, Montana in Switzerland, and Andermatt Sedrun. This international expansion is a big part of their strategy for growth, but also brings in new risks like currency fluctuations and navigating different legal and regulatory environments. When we look at their debt situation at the 31st of July 2025, Vail Resorts Incorporated had $3.2 billion in total debt. This is a substantial amount, and they acknowledge it could impact their ability to react to market changes, and fulfill their obligations. They have significant debt from credit agreements, senior notes, and convertible notes. While they have managed to maintain compliance with their covenants, it is clear that managing this debt load is a constant focus. Now let's look at how they handle their assets, particularly goodwill and intangible assets. They have $1.67 billion in goodwill as of the 31st of July 2025. This usually comes from acquiring companies for more than their net asset value and signals a strong belief in the future earnings potential of those acquisitions. They also have significant intangible assets like trademarks with an estimated fair value of $252 million. The key here is that they evaluate these assets annually for impairment. If their future earnings projections are not met, an impairment charge could significantly impact their financial statements. Looking at how they reward their executives and employees, we find their stock compensation plans. Throughout the years, they have granted significant amounts of stock appreciation rights and restricted share units. For example, in 2025, they granted 262,000 SARs and 172,000 REs. This is a common way for companies to align employee interests with shareholder interests, but it also means significant stock dilution and compensation expense. The financial tables reveal a very strong performance in their core mountain segment. For the year ending the 31st of July 2025, Mountain net revenue grew 3.4% to $2.6 billion, mostly driven by a 4.2% increase in lift revenue. This suggests their pricing strategies and past sales are working well. Overall, Vail Resorts Incorporated appears to be a robust company with strong profitability in its core operations. They have a clear strategy of acquiring and integrating resorts and leveraging their past products to drive customer loyalty and revenue stability. Their international expansion shows ambition, but also introduces new complexities and risks. The significant debt load is a factor to monitor, especially in a rising interest rate environment. Their ability to manage weather-related risks and economic downturns while continuing to innovate with technology and guest experience will be key to their future success. It's a business that is heavily influenced by external factors like the economy and the weather, but they are actively working to mitigate these through strategic investments and diverse offerings. That is our deep dive into Vail Resorts Incorporated's latest filing. What do you think about their financial health and future prospects? Let us know in the comments below. If you found this breakdown useful, give this video a like and subscribe for more corporate dissections. And be sure to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.